Hello, I'm Doran, Client Portfolio Manager with Russell Investments. I am joined by Soerensen, Portfolio Manager on our Emerging Market Equity team. Today, I will give you a brief introduction to Russell Investments and our multi-manager capability, and with Soeren's help, we will look at why emerging markets are attractive and some key considerations for equity investors. Soeren, good to see you.
Hi Stephen, it's good to be here today. As Stephen mentioned, I'm a portfolio manager on the Emerging Markets Equity desk at Russell Investments, and I've been serving Russell Investments clients for the last 13 years.
So who are Russell Investments? We are one of the world's largest financial solution providers. Established 85 years ago, we have $2.8 trillion of assets under advice. We serve a host of clients from independent financial advisors right through to some of the world's largest companies or pension schemes. Today, I'm going to focus on our multi-manager capabilities, identifying the best managers around the globe. Now note, I'm using the term managers. We do not invest in or research funds. When seeking investment opportunities, we believe it is important to cast the widest possible net. Not all of the best investors in the world have funds or pooled vehicles. With our global reach, we have the ability to follow over 14,000 different investment strategies. We build up in-depth knowledge of our managers through quantitative and qualitative research, using our proprietary database and our highly experienced manager researchers. Now, experience is incredibly important. The average analyst has 19 years of experience. As a manager research colleague said, investors are typically smart, eloquent people. The first 50 meetings you have, they all sound brilliant. It's only once you've had your 150th or 200th meeting do you really understand who is a step ahead. Once we've identified the best investors around the globe, our portfolio managers, like Soeren, bring those insights together to create a portfolio of multiple managers with different skills or styles to diversify and help deliver a smoother investment journey for clients. Now, Soeren, turning to your area, emerging markets. Emerging markets have lagged their developed market counterparts for a number of years now, and you don't have to look too hard in newspapers to see headlines regarding geopolitical risk in Russia or issues with governance and state-owned enterprises. Why should investors invest in emerging markets?
Yes, I mean, that is all true. If you just read newspaper headlines, you're almost guaranteed to get a steady supply of reasons not to invest in emerging markets just about every single day. But I mean, there is obviously political risk in emerging markets, but even in developed markets, there's plenty of political risk. I mean, just look at Donald Trump. I mean, I guess he's not in office any longer, but political risk exists everywhere. It's part of the investment landscape, and as an investor, you need to be mindful of the political backdrop for sure. But if you look through the volatility and observe the underlying economic drivers in emerging markets, it's a very exciting opportunity set. You find many economies with a young and growing labor force, and even in countries like China, where demographics are less favorable, you've still got a growing middle class, urbanization, all these dynamics that are favorable. And it shows through in the numbers in terms of GDP growth. Emerging markets, if you rewind time 10 years, it was only 35% of global GDP, and now it's more than 40. So yes, it's growing in importance, but then when you look at it from an equity point of view, it's still only about 13% in the all country world index today. So from an equity market cap point of view, it's sort of comparatively a bit of a underrepresentation compared to the economic scale. So there's ample room for this to grow, and on the demand side, I mean, you got 85% of the global population living in these countries. So average income levels are obviously much lower than they are in developed world, but again, that spells opportunity because there's so much room to grow from a low base. And on the supply side, in terms of productivity, again, we're starting from a much lower base in most emerging markets. So with the right reforms, many economies, and particularly what we've seen out in Asia, they've proven that it is possible to generate rather explosive growth by just emulating what's already being done in other economies and then putting your own spin on it, so to speak. And so that's all that. But I mean, obviously, there's no direct link in the sense that there's no guarantee that high GDP growth necessarily leads directly to good investment returns. But all of the factors that I just mentioned, they set the scene for this diverse set of businesses within this opportunity set. That they have the opportunity to grow very rapidly, thrive and prosper individually, many of these businesses. And so as an active investor, it's a really exciting and deep and diverse opportunity set to get involved with. And currently there's more than 1,400 stocks just in the MSCI Emerging Markets Index, which is a number that has grown explosively over the past 5 years. And especially in China. So in China, we've had a lot of financial markets reforms that have been very ambitious. And so that's gradually enabled investors to get more exposure to the large domestic exchanges in Shanghai and Shenzhen. Those two exchanges, if you look at the combined market cap, they're second only to the US market, very liquid, and until fairly recently, they were largely off limits to many investors. And that all changed with, Stock Connect was a big part of that. And since May of 2018, MSCI started to include these shares in their suite of indices. And so already at this stage, we have hundreds of new companies added to the MSCI EM index through that avenue. And many of these businesses are tapped directly into domestic consumption growth in China. And it's just a very different opportunity set. It behaves very differently from what you see elsewhere, which brings with it diversification benefits as well.
You've addressed some of the fundamental reasons for investing in emerging markets. However, sustainability or ESG investing is at the forefront of many investors' minds. Is it possible to invest in emerging markets and still be sustainable?
Yes, absolutely. Emerging markets is absolutely key to delivering on climate-related goals, for example. It's well known that China is the world's workshop, essentially. It is the biggest polluter in the world, objectively. But at the same time, China is also the global leader in electric vehicles, for example, and a big part of the supply chain for electric vehicles, solar power, wind power, all these great things that will make the world better, they all rely on input from emerging markets. So anything from battery technology, but also raw materials like copper, for example. If you create an electric vehicle, you need lots of copper wires. So all of that, a lot of that is coming from emerging markets, and you are seeing big commitments, and you see aggressive targets from governments in large EM markets like China and Brazil to address these issues. So when you look at the opportunity set, I think there's historically been this conception that natural resources were a big part of emerging markets, and yes, they're still there, but they no longer remain a dominant driver. If you just purely look at the weights in the index, the entire materials and energy sector, for example, we looked at it last year. At one point last year, they were smaller than the two individual largest internet names in the index. So things have really changed over the last 10 years, and it's a different index now. And even those mining companies that are there, as I mentioned before, for example, some of them, they're copper miners. You need copper in order to provide that green revolution. So a little bit similar to the discussion about GDP growth, and we're starting from a low level in emerging markets in certain respects as regards ESG compared to where we're at in Europe. But China and other emerging markets nations, they do produce all these things that we like to consume in the West, and so they create a lot of pollution. And so if we want to create positive change, we do definitely have to invest in emerging markets. That's exactly what we need to do. But we have to get a seat at the table and engage with these businesses. And over time, as foreign institutional ownership increases, especially, for example, from Europe, where people are very conscious about these things, that's going to only have a positive impact on the trajectory in the places where it really matters. So lots of exciting things happening in emerging markets on that front. If you invest in a company that's already sort of squeaky clean from an ESG point of view, you don't really have an ability to cause marginal improvements. Whereas if you go in and get involved with, for example, a large regional cement producer somewhere in emerging markets and help them along with rolling out more environmentally friendly technology, that can have a really sizable positive impact globally on reducing CO2 emissions. So there's that. So, but there's also the governance angle, of course. This has always been key for investors in emerging markets. You can't just blindly buy the benchmark. Or I mean, technically you can, but if you do, you'll get the good, the bad, and the ugly inside of your portfolio. And it's really important to have local knowledge and expertise to really understand the sort of the investments you're getting involved with and increase the probability of sidestepping some of the issues you might encounter on that front in EM.
Another trend we're seeing is an increase in index investing. In developed markets, large cap technology stocks are really driving the returns of markets, leading many commentators to say that active management is dead. Are we seeing the same dynamics within emerging markets?
Well, I mean, the last 5 years, let's be honest, they're pretty difficult for active equity managers in general, and emerging markets included into that. And like you said, the media provided various analysis to indicate that active management is dead, so to speak. And Russell Investments as an organization, we've been managing money in emerging markets for more than 30 years. And we've been adding value to clients both in an absolute and a relative sense by beating the benchmark throughout that period with a broad array of active strategies employed. So I always take such sort of spur of the moment conclusions with a grain of salt. But yes, I mean, it's true. It's been a difficult period for active management in a historical context. We've been through such periods before, and we're now starting to see a reversal in that dynamic. But I'm a visual person, and one chart I like to look at that really underscores one of the key reasons why it has been a difficult environment to manage money in is this one. So when you look at this chart, the orange shaded area, that represents the rolling 1 year relative performance of the small and mid-cap emerging markets benchmark compared to the broader market over the past 20 years or so. And when you look at that, you can see up until 2016, the small and mid-caps, they rarely spent much time in negative territory. And when they did, for example, during the global financial crisis, they quickly recovered within just about a year or so. But what we've seen more recently, since 16, that's the longest period, at least this side of the millennium, with small and mid caps underperforming on a 1 year rolling basis. And interestingly, so this dynamic coincided with the arrival of the large Chinese internet names as dominant drivers in the emerging markets opportunity set. And many of these businesses, they entered the index through large-scale IPOs, often priced somewhat to perfection, and it just made it difficult for active managers, at least those with some degree of valuation discipline, to get involved at large scale enough to really go to an overweight in these types of names. And so some of these businesses quickly grew to become more upwards of 5% of the entire opportunity set. And so that's been a real curveball, I would say, for active managers as these companies have been compounding rather aggressively. But I don't think active management, it's not broken, but many active managers, they have had a tilt towards the smaller cap end of the market, and most have had some degree of valuation discipline, which obviously is a sound investment principle for the long term, which has also been proven out again recently in recent quarters, when we quote unquote finally saw that aggressive valuations in the internet segment of the market unwind. And in a benchmark relative sense, it's been a very painful process to remain patient with that. But when the market got, as the market got more and more excessively concentrated and certain pockets of the market got excessively expensive, but we're seeing the reverse dynamic now.
You mentioned that small cap and valuation have been a headwind for active management. Does that mean that simply investing in a single large cap growth manager is the answer for investors?
Yeah, I mean, there are a lot of good emerging markets managers out there, including growth managers. We can vouch for that. And I guess the reason we as an organization prefer the open architecture approach is that we don't believe that anybody, irrespective their resources and experience, have come up with the one and only way to invest successfully. I mean, there's some fantastic growth managers, but as a matter of fact, we believe and have seen proven out over time that there's a multitude of ways that you can beat the market, that there's nothing wrong with sticking to a single narrow approach when you invest, like for example, say long duration growth, but especially if you've got the risk tolerance, you've got the patience and you've got the commitment to do so. As a matter of fact, we do really like investors that stick to their process, but we do think it does unduly increase the risk of us as investors. I mean, we're all human beings at the end of the day, and we do then have a higher risk of falling prey to behavioral biases. And I think that the best way to illustrate this, as I mentioned, that I like pictures. So on this chart, you can see the rolling 1 year excess return of 5 different Russell investment factor portfolios, and all of these are measured against the broader EM index. So what you see is there's a growth, a low volatility, a momentum factor portfolio, a quality, and a value factor portfolio. And so just looking at those stylistically, if we use these as proxies for sort of a naive proxy for different ways of attempting to beat the market, as you can see on the screen, I mean, it all looks a little bit like a bowl of spaghetti almost. The one zigs, the other one zags. And but what I want to bring across here is sometimes these lines get quite far away from zero, and especially on the downside, it can at times be very difficult to remain invested when you're deeply under the water. So for example, the gray line, it represents value as a style. And you can see the large drawdown, very recent memory here, throughout 19 and 20. And there are many articles in the papers about how value as an investment style is dead, etc. And right at the peak of pessimism about value investing last year, then all of a sudden you see this reversal, and the last 9 months have been some of the better months on record to be invested in value stocks. So we see this, I mean, and when you sort of zoom out and look at 20 years, you can see that happening over and over again. And on the flip side, over the last 9 months, if you're invested 9 months ago in long duration growth managers, it seems whatever they touched throughout the pandemic turned to gold. And at that point, it's very easy to conclude that we should all be growth investors. But obviously, again, the last 9 months have proven that going all in on that approach would have been exactly the wrong thing to do at that point. And so rather than playing that game and sort of falling prey to our own behavioral biases, we believe that there's a genuine free lunch to be had if you can identify strong active managers that are doing different things. By all means, you should hire a strong growth manager, we think, and should probably also hire a strong value manager. You should probably hire a manager focused on the smaller market cap end of the spectrum. You might pick a manager focused on the deep opportunity set we see in China, etc. So you have all these different building blocks that bring something different to the table. And so what we're doing is when we construct portfolios, we have a buy list of the very best of breed managers maintained by our very experienced research team. And then we go through that list and we look at these diverse strategies, and we select those that sort of fit together and bring something different to the table. And what we then end up doing is we end up harvesting the average return from each of these managers. And at the same time, we diversify away a lot of that noise, a lot of that sort of spaghetti noise you saw on the other chart, in a benchmark relative sense, that the volatility against the benchmark is reduced, which just makes it a lot easier psychologically to stick with the process irrespective of the market environment, and then reap the long-term benefits that can be had through active manager selection.
What are the benefits of blending so many active managers? Do you not just end up with more index-like returns? Would it not be better to pick one or two high conviction managers within the portfolio?
That is a very good question. I mean, there obviously is not just one way about this. You can pick just a couple of high conviction managers for sure. But again, I mean, apologies if I become too visual here, but I think a graphical illustration might help explain this one as well. So what you've got here on the two axes are expected tracking error along the x-axis and expected return along the y-axis. So if you're trying to tackle the opportunity set of active managers, you can do it in many ways, but stylistically, they're three of the more attractive options presented here on this slide. And before getting into that, we presuppose that you have got a strong manager research function at your disposal, and that's able to select skillful managers, just like we do at Russell Investments. So we're only looking at managers that have a process capable of beating the market. But under the assumption that you have that, then you could pick a somewhat core proposition. You could pick highly skilled managers that have somewhat core holdings, holds a lot of exposure in benchmark stocks. And if you do that, probably you just need one or a few, as they're solidly anchored on the benchmark. So you won't get much volatility against the benchmark from this, for the same reason that they own a lot of the benchmark. Even though they have got skill, they won't have that much risk budget because for the same reason. So it'll be a higher hurdle for these types of managers to create very attractive excess returns. But I mean, this can be absolutely fine. It has the potential to deliver some excess return with modest risk. Nothing wrong with that. Now, the next option on the list would be what we could illustrate here as the red chilies. So you pick a selection of maybe one or maybe a few highly skilled, highly active managers that don't care too much about the benchmark. If these are truly skilled and backing their convictions aggressively, you'll likely accrue very high active returns. But some years you should just expect that you will see double-digit drawdowns versus the benchmark. And if you can stomach that, then go for one or two of the red chilies and you're just fine. As long as you don't panic and sell at the bottom, which is always very tempting. A fund manager never sounds very clever when they're down 10%, and they sound very clever when they're up 10%. It's just human nature. And then you can probably guess what the last portfolio is. This is how we like to construct our own portfolios. So you have the building blocks are generally red chilies, if you like. So we like to pick high conviction, highly active managers, and the aggregate outcome represents the average return of all of these strategies that we put into a portfolio. But the volatility, importantly, is diversified down to a more palatable level, somewhat similar to if you're invested in a more core proposition. And so this is generally the free lunch, so to speak, as long as you have strong enough research capability, manager research capability, to identify enough of these highly skilled, highly active, and highly diversified strategies and put them into portfolio. And that's what we show up every day to do, whether our opportunity set is emerging markets, China, or anywhere else our clients need to get exposure.
Unfortunately, that's all we have time for today, Soeren. Thank you for joining us. I hope you found that useful. In this brief video, we've only been able to scratch the surface of Russell Investments and our multi-manager capabilities. However, if you would like to learn more or discuss anything further, please do reach out to your usual Russell Investments representative or use the contact details at the end of this video.